back. We're continuing our conversations here at Davos 2024. Joining me now is Gita Gopinath from the IMF. Gita, always a pleasure. Many thanks for joining us here on CNBC-TV18 and Happy New Year to you.
Happy New Year, Shereen.
Well, Gita, I want to start by talking to you about your New Year wish. You said, I hope inflation is truly conquered in 2024. We have soft landings and more conflicts get resolved than get started. Of these three, which do you feel most confident of being realized in the year ahead?
I think we might see a soft landing. I have a little more optimism about that, which of course means that we would have also gone a whole long way in terms of bringing inflation down, right? So what we've seen in the past year is actually a quite resilient global economy with some pockets of strong resilience like the US. But China also did somewhat better than we expected in the second half, and several other emerging markets, including India, did better. But that came along with inflation coming down. So it meant that central banks could take their time to assess the situation, and we didn't see very dramatic further interest rate increases. So the odds of a soft landing have definitely improved.
Odds of a soft landing have improved, but let's talk about interest rates. And now the challenge as far as central bankers are concerned, as you rightly said, inflation has started to temper. The Fed's on pause at this point in time. The question now is, when do we start to see the rate cycle turn? When do we start to see the first cuts come in? But even when the cuts do come in, what are we talking about in terms of higher for longer? What does that mean exactly? What will the new normal be as far as rates are concerned?
So the Fed clearly has a challenging few months ahead of them, because this is, in some sense, trying to get the final descent of inflation back down to target and to stick the landing so that you don't have it, you hit the target and then again you bounce off of it. You don't want that to happen. So that's where they are. My sense is that they should be cautious and be data dependent. They've gotten inflation to come down quite a bit. A big chunk of that has come because of improvements in supply side and supply chain disruptions. Labor markets are still tight in the US. So while there are both upside and downside risks to inflation, the problem is that once they cut, then that really solidifies further rate cuts. And you have a tremendous easing of financial conditions, which can again defeat the purpose. So going cautiously, and as of now, again, given what we see in the data, we expect cuts to happen more towards the second half of this year than in the first half of this year. But of course, you have to be data dependent and follow data as it comes in.
Yes, I would imagine that is what they will do, and that's the position as far as the RBI is concerned in India as well. But let's talk about India, Gita, and you said that India has done better than what was expected and what was estimated by the IMF. What do you like about the India story today, and specifically from an FDI perspective? I mean, every global CEO that we speak to is bullish on India, but FDI is still lower than the historical averages, even in the last 3-4 years. So how do you see that playing out in the context of this supply chain diversification that is underway today?
So India continues to be among the fastest growing major economies in the world. We expect that to continue into 2024. So that's a very positive story. There are other reasons why investors are looking at India, because of the shift away from, say, locating production in China and moving more of that to other countries, including India. You're right, though, there is a disconnect between the number of projects that are being announced, foreign direct investment projects that are being announced going into India. You've seen a real sharp increase in that, as opposed to when you actually see the money that's coming in. The money that's coming in, you're not seeing that yet. Now, this, of course, can take time. The only thing India can continue to do is keep on the reform path. Building infrastructure is critical, and of course they've done really well on that front, both in terms of roads and ports and transportation and so on, but also in terms of the digital infrastructure. Both of those are winning strategies, and they should continue on that front. But many more reforms are required, including on labor markets, on land, even in the ease of doing business, addressing corruption. I mean, all of this, usually, if you want to see a sea change in a country's, how attractive a country is for investment, is you see reforms on multiple fronts. And as long as, India continues on that path, I think, yes, that's very promising.
But overall, as far as FDI is concerned, and in the context of this move towards deglobalization, as well as the risk of fragmentation and increased fragmentation that you speak of as well, realistically, should we recalibrate the expectation as far as FDI is concerned?
Well, I mean, for a country like India, given that it seems to be on the it kind of benefits from the tensions that we are seeing right now between the US and China, that could make it a positive story for India. But at the same time, India, like every other country, should keep in mind that if this fragmentation continues, then we're all fighting for maybe a bigger share, but of a smaller pie.
Right.
And that is a real risk that we've been flagging at the IMF, that this is a slippery slope. And you see that. You see retaliation and counter-retaliation when you have, one country imposes a tariff, the other country retaliates from it. That's a kind of slippery slope we should be careful not to go down.
And if we continue to go down this path, what could it potentially do in terms of shaving off growth as far as global GDP is concerned?
So we've done multiple simulations of this depending upon the extent to which the decoupling happens. It can, be as small as 0.5% of world GDP if it's very well contained, but it can go all the way up to 7% of GDP if you see some very serious decoupling. So it's a big hit. And in an environment where our medium-term growth projections are one of the lowest they've been in a couple of decades.
Yeah. Speaking of risks, that's one of the risks that you're flagging, but a potential risk at this point in time is also the flare-up that we are seeing in the Middle East, because that's directly in the near term impacting what's happening as far as trade is concerned with the attacks on ships and containers in the Red Sea. We've already seen what that's done to freight rates. How are you factoring that into the growth scenario, and potentially what could it do to offset the kind of projections that you have?
So that is a risk that we are monitoring. Now, if you look at oil prices, they are below where they were before the Israel-Gaza conflict started, right? So there are other forces that are moving energy prices in the downward direction. But of course, if there is a much greater regional escalation, this can be problematic. As of now, the disruptions that we're seeing in the Red Sea is particularly tough for trade that's going from Asia to Europe. Less so for Asia to the US because they follow a different route. So we are seeing disruptions of that kind. Nowhere in the world during the pandemic when we saw really severe disruptions. But, the conflict is not over, and you are seeing more, kind of it expand in some ways. And that's where we are particularly, watching carefully to see where we might see some downside risks.
Here in Davos, Gita, everyone's talking about AI, the transformative impact of that, what it could potentially do to jobs, what it could do in terms of disrupting different sectors. What's your view on what AI could mean for the global economy?
Yeah, so as you've seen, if you talk about AI to anybody, they can pick different facets of it, right, in terms of misinformation, but also on the impact on the labor markets and so on. So we've actually done a pretty careful study on potential impact on the labor market. And our assessment is that about 40% of jobs globally, on average, 40% are vulnerable to AI. Right, that's a big number.
That's a big number,
now, that varies. So if you look at the US, the 60%, that number would be 60%. If you look at India, that number is 30% because you have a large share of workers that are in the agricultural sector, which is not affected by AI, especially not the generative AI. Now, then there is a question of this, if I take the US, and of the 60%, what fraction benefit from, get complementary, benefits from the AI, right? Become more productive because they have AI, versus how many of them are actually going to get substituted out, which means more likely to lose a job. And that then gets to it's about half of that 60% number, right? So we're talking about very large fractions of the population who are at risk of, at least if not losing their job, but in a sense being devalued a bit by the presence of AI, but also an important share that can benefit from it. The risks on inequality growing, especially wealth inequality, is something also that we flagged in this new research that we've put out. So
another challenge that policymakers are going to have to deal with, not just in 2024, but over the next several years, I would imagine, as this plays itself out.
Yes, I think they're also policymakers at this point also trying to grapple with the whole thing, trying to understand
what does it mean
exactly, how is it going to transform the world and the details of it. So, all of this analytical work is also going to happen now, and policies, yes, for the G7, addressing AI is like one of their top priorities this year.
Let's talk about China, because you said that China did better than what you were expecting. But the view is that given the debt that they're dealing with at this point in time, and just given the way that they have tried to clamp down across the board on many industries, that they're unlikely to go back to that 5% kind of growth rate expectation. What's the view? What's the take on China?
So for China, we upgraded our growth. We did it in November because the second half was somewhat better than we expected. So they certainly meet the 5% target. We have it at 5.4% for this year. Next year, it goes down to 4.6%. And then in the medium term, we're looking at more like 3.5%. So you're right, the trajectory certainly is with growth coming down. And the two big challenges they have is the property sector and local government finances. I think those two pieces are creating kind of sentiment in China which is not very conducive to bringing strong consumption back and strong private investment back. These are some of the concerns there. But it has potential, and as long as it's able to undertake meaningful reforms, more market-friendly reforms, you know, it can still get back those high growth numbers.
That's the expectation, but you know, given the government's stance on many of these issues, do you feel confident that we could potentially see them chart a reversal?
Yeah. I mean, as you see, our baseline projection is for growth to slow quite meaningfully. At the same time, you know, most recently they've announced a few more stimulus measures, which is part of the reason why we've upgraded our forecast. And there is the intention, but we'll have to see actual policies being announced and implemented.
So, you know, if I were to ask you to map out for me the big trends that you're going to be watching out for that could potentially shape the year ahead, what would those be?
I think first and foremost, I'm going to watch carefully what's happening with inflation in the major economies to see whether it is, you know, coming back to the target so that we actually nail the landing and we stay there. I think that's going to be important because it's not just important for these countries, it's important for the world as a whole.
But you feel confident of being able to nail the landing on inflation?
I would not say confident. I would say that that is our baseline scenario, but there is uncertainty around it because it's not over yet. The job is not done. I think that is the first message I would send. The second is we're seeing differences across parts of the world in the strength of their economies. The US economy is actually very resilient. The euro area, you know, Europe, you're seeing more weakness because of the energy shock that they had to face. India is doing well. You know, China faces these headwinds that we're looking forward. And we are moving to your first question about the interest rate world we are in.
Yeah.
You know, we are, I believe, moving away from that period right after the global financial crisis up till the pandemic when interest rates were like hitting zero and there was abundant liquidity. So we are moving to an environment where I think funding costs are going to be higher than that period. It's certainly going to come down in the next year or two, but it's still going to be higher than that decade of real abundant liquidity that we saw. And that has implications for funding costs around the world.
So an uncertain 2024 patchy recovery, is that the expectation that you walk away from Davos?
I think the positive way to think about it is that the expectations were much more severe, that the world would have countries in recession, and we have not seen that. So let's take a positive take on this. But the work is not done, and we have a medium-term growth outlook that is weak, and we need to work to improve that.
Gita, always a pleasure. Many thanks for joining us on CNBC-TV18, and we look forward to seeing more of you back in India.
Thank you, Shereen. Always a pleasure to join you.
Well, we are going to take a break, but the conversations will continue here. Stay with us. Back in a moment with plenty more.